Well, in investing, there are a lot of cliches. Buy when others are greedy, sell when others are, or no, buy when others are fearful, sell when others are greedy. That's one. The trend is your friend. That's another. And here on Pre-Market Prep, we have identified our own trend where the market tends to go down when Joel is gone. Is that trend officially dead today? What is going on? Everything is ripping. We've got a couple of earnings to talk about. Not a lot, though, but of course, got to talk about the interest rate decision yesterday, the reaction, the delayed reaction. Let's go ahead and get pre-market prep started. We got Tim Seymour joining us later in the show around 8:45. Make sure to stay tuned for that. Let's get it rolling. Welcome to Benzinga's pre-market prep.
This is a volatile puppy here.
It's all about execution styles and strategies.
Well, if you were really bullish going into the rate cut decision yesterday, you probably weren't too thrilled with the reaction. But if you held on overnight, now you're feeling a little bit better this morning. Let's get my Benzinga Pro pulled up. We'll run through the indices real quick. Look at that. The S&P 500 up 1.62% before the market even opens. You go to the Qs. That is not true. The Qs are not down. We're getting some of those 8 o'clock FINRA prints. The Qs are up more than 2%, or they were last time I checked. I don't even know if it's worth looking at the numbers here right now. Bitcoin, there's no 8 o'clock prints on Bitcoin because that's trading 24 hours. Bitcoin ripping higher, up at $62,500. Let's go ahead and bring Dennis in because this is kind of a crazy morning. Dennis, how are you doing?
Wow. I'm just in shock, kind of just, you'd expect a bounce back overnight. This is what they do. They sell them during the day. They buy them at night. We got some stats to prove this in a few minutes, but I did not foresee an 80-point sell-off on the 50 basis point cut and then a 90-point rally on the S&P. Random walk theory being proven correct here this morning because this is all random. Random moves right now. We've talked about chop, and we expected chop. This is the chop of all chop. Because if you were trading and you were buying and you were an algo and you were saying 50 to the moon, and they bought, up 10, 20, 30, 40, 50 S&P points is ripping. By the end of the day, they were all down money because we closed red. Doesn't matter, though, because when you close red, you just rip them overnight, you pump it overnight, and you get your money back. Wow. I mean, just the action here is nothing short of incredible. Feels almost manipulated. It's such a ridiculous rally, but let's get, the chat's thoughts on this rally here too. Obviously, people love up markets because majority of people are long. So, Jim Cramer tweeting out, what a fantastic night. Everybody, fantastic. It's a good night if you're an investor. If you're short, not a good night.
Well, I think, I guess like if I wanted to play devil's advocate, I could argue, I guess the random walk was yesterday and that today would be kind of what I expected. The IWM is ripping up 2.5%. You look at clean energy, TAN up 3.5%. Like these were the sectors that we thought would do well with interest rate cuts. We got the interest rate cut, the big one. We got more, insights from the Fed on future interest rate cuts. They expect to cut another 0.5% by the end of the year. So it's not, I guess, I'm not shocked to see these, which sectors are driving the market higher this morning. I was a little bit more shocked to not see them move higher yesterday, but sometimes I guess the market does have these delayed reactions. But either way, everything is in the green. Essentially, pretty much everything is ripping. Someone in the chat was asking a good question. What about laggards? Which on a day like today, it's hard to even kind of find some laggards.
Yeah. So I'm looking at basically the 200 stocks that I trade the most often in the S&P and looking for something in the red. Procter & Gamble, I see it's just ticked red. well, it's defensive consumer staples. So I'd expect consumer staples to lag and possibly go down because they're defensive.
And that's what I'm saying. It doesn't feel like a
That's pretty much it.
Random.
On my screen, the most shocking thing you can see is that there, of all those stocks that I trade, I got Procter and Gamble, the only one clearly in the red. Visa says it's in the red, but it's not in the red. That was an 8 o'clock tick. That's a bad tick. It's actually up $3. So that's shocking in itself. I mean, unbelievable. It's broad-based. It's everything rallying. Expect, though, consumer staples to show relative weakness here, meaning that some of these are going to actually go red. So I wouldn't be buying like a Coke up 1% or, you know, some of these other consumer staples up 1.5% here. Don't be chasing. I wouldn't be chasing consumer staples on a day like this.
So what
But
you're saying?
Said, I don't think I'm chasing anything on a day like this. I mean, and go ahead, AB. What, you're going to make a point?
I was just going to say, so you're saying the laggards are lagging for a reason.
There isn't really a lot of laggards here today.
But the consumer staples.
The overnight action and the overseas action was nothing short of incredible here, too. I mean, look at what happened. Japan maybe kicked it off. Japan up. You can look at the EWJ if you want to see it. Up 2.4% here overnight. That's where the EWJ is. You've got the European markets trading up 2%. And then you have China. That is up huge. The FXI up 3.21%. So reasons for the rally, definitely overseas markets ripped. And you can say, well, that was a delayed reaction to our markets. But our markets closed down the S&P. So we can't really say that. QQQ's closed down. IWM close to closing down. I don't know if it actually closed red, but gave back all those gains intraday. So the overseas market's actually saving the U.S. markets here overnight with the incredible action starting at 7 o'clock last night with Japan. Started going up, and then they really started buying the S&Ps overnight. But I want to go to something we've talked about on this show a lot. And you can bring up this chart that we've talked about, and it's a paper, and this paper is and this you know has been published in different places. But Phil McIntosh, not a new paper, but just showing it. This is Phil McIntosh from the NASDAQ chief economist. This paper from a number of years ago. He wrote this back. I don't have the date on it, but the paper's called Like Night and Day, and charting the S&P's return up till December 29th, 2023. So the paper is fairly recent because he's got data up till the end of last year. So he's charting in the last 30 years of returns. And it's very important to look at this chart because this is going to be shocking to a lot of people. So this is cumulative returns, looking at cumulative returns on a log. But if you actually look at the stats, over the last 30 years, combined intraday returns, the combined intraday return over the last 30 years, not every year, talking the combined return intraday over the last 30 years, meaning buying the open and selling the close. If you were to do that over the last 30 years, you're only up 12% at the end of 2023. The markets are only up 12%, barely positive, not 12% a year, 12% total. Overnight returns are up 2,000%. 2,000. So basically, if you buy the open and sell the close every single day for the last 30 years, you're up basically nothing. But if you buy the close and sell the open, you're up 2,000%. Put it another way, the entire return in the S&P over the last 30 years is overnight. The entire thing, and nothing is intraday. So intraday, you just chop around and go nowhere, which I've talked about on this show forever. Overnight, you ramp up. You typically ramp up. And what did we see here over the last day? Nothing returning yesterday, overnight, everything returning. This paper is the last 2 days. This is why, folks, I switched primarily to overnight trading 15 years ago, because I saw my returns were better overnight. You know, I'm not that, I always say I don't trade 10:30 to 2:30, middle of the day, because it's just choppy, random walk going nowhere. But a lot of returns are predictable, like, you know, all those strategies that I employ, buying stocks a couple days ahead of the returns, holding them overnight because they get ramped up overnight. This is just a crazy stat, absolutely crazy. It's telling you you're intraday day trader, you're day trader that says, I don't hold anything overnight because there's risk. hard to make money when the markets go nowhere intraday. But if you're a swing trader and you're holding overnight, or if you're an investor and you're holding overnight, or if you're an overnight trader like me, there's all kinds of excess returns in the overnight markets. But you got to take risk. The risk is news comes out on your stock overnight. Other things can happen. You know, we know there's macro headlines that come out overnight, but just shocking statistic there. And again, Phil's not the only person that said this. This has been out there. It's not like this paper just enlightened us. We know that there's always overnight, but he's done a really nice job of simplifying it. Just go scroll up a little bit. It says, in fact, you can see those stats over 30 years in this chart. Intraday returns, go down a little bit. You just missed it. Go slower. Right there. Show that. Intraday returns barely positive over the last 30 years. Cumulative, not 12% a year, 12% total. Overnight returns up close to 20-fold. Buy and hold, fine, because you get the whole thing. You're just buying and holding 20-fold. So basically the entire, I'm going to say it again because it's so important, the entire return in the S&P over the last 30 years is overnight. The entire thing. Intraday, a zippo, a zilch, a nada. So keep that in mind, folks, when you're sitting here and trying to buy stocks intraday, and I don't hold overnight. It's a tough gig. It's a lot better gig to be looking at strategies that include overnight trading, especially if you're a long investor. Maybe you want to just be playing that out. There's a strategy involved. Just maybe you sell in the open and buy in the close every day. It seems to work. But, you know, that's just the point here. But wow, you know, if you were doing that yesterday, you killed it.
It's the and shout out Carmen in the chat, but it's the Bob Seger market, Dennis.
What was Bob Seger's song? Is there a song in there?
Night Moves.
Oh yeah, great song.
It is a great song.
We're working on some night moves.
It's a great.
I'm not a singer, but that's a great song.
It's a great like
night
summer.
Moves. That's it.
It's a great
night moves.
It's a great summer night song too. Like you're outside, you got like a fire going in the night, and it's playing, and maybe you have an adult beverage, a beer in your hand. It's a great song. But no, I mean and that's why. And look, like this is not financial advice really, but someone in the chat, you know, said like, "Oh, is this why 90% of day traders lose money?" And I know our chat primarily a lot of people that are, you know, trading actively. That's why you're watching this show. But I would like if I had friends that wanted to get into day trading or whatever, I'd tell them, I'd be like, yeah, sure, like, you know, use some of your money for that, but like also have your investment portfolio. Also just be like buying and holding, because that's what's been proven to work over time. And the other stat that we talked about in the pre-market show that I don't have in front of me or the chart to show it, but you know, I've seen a lot of people put it together, is that if you aren't invested in the market on like the 5 biggest days of the year versus if you are on those 5 days of the year, your returns are way worse. Because you know, yeah, they're nothing. And like, you know, you will have those, you know, maybe say 5-10 days a year where the S&P like today is up 2% and all your mega cap tech stocks are ripping up 3-4%. If you miss out on those days, your returns are just not as good overall. And so, you know, there's just a lot of historical data that indicates that buying and holding and even through volatility is by far the best strategy to actually like growing your wealth. And day trading, like, you know, I mean, Dennis, I know you outperform your investment account with your trading account, but that's because
my trading account is overnight.
Overnight, yeah, exactly. So and most people
are an overnight trader. I'm not your typical day trader where I'm sitting there all day. I stopped doing that in 2010. It just got too difficult with high frequency trading. It got too efficient. It got too choppy. It's like no trend. It was just, you know, but overnight there's predictable moves. You know, overnight headlines. I say you can make money trading headlines, you know, and that's what we try to teach on the show. Different types of strategy there. But, you know, there's 2 primary reasons why intraday day traders fail. Is one, the charts we just showed, and then people are primarily long. A lot of people don't go short stocks. But 2, the biggest thing is commissions, you know, where when you're trading excessively, you know, you're commissioned and you can say, well, I don't have commissions anymore. Well, you do indirectly, folks, because you're paying spreads. So, you know, they eliminated commissions because they force you to pay the spread. We know Citadel dominates the spread. You know, you sit on the bed, you know, you only get filled when the bid becomes the offer, you know, like it's always grabbing the spread on you. So, I mean, spreads kill you. 1 cent here, 1 cent there. It just adds up. And then if you're, you know, trading, you know, and you're at a pro or whatever, and you are paying commission, that all adds up too. So it is expenses. But I have lots of expenses, you know, and there is opportunities here. I just feel like, and I'm not saying you have to trade. This isn't saying to trade actively overnight, just to correct. This paper is saying to buy the close and sell the open. That was the strategy. And again, to the paper, if you read it in deeper, over the last number of years, there has been some pause. We can see, you know, there was like this first like half is like really bad. And then lately, you know, in the last 15 years, intraday trading has come up a little bit. But still, overall, definitely outperforming is overnight trading because there's more risk there. More risk, more return.
So, okay, as we stand right now, we know now the Fed is cutting rates. I'll go back to my Benzinga Pro. You know, we got that delayed reaction today. What's curious to me, Dennis, is it's still, and I guess my like gut feeling is that even with the market now at all-time highs, that people are still, there's not this like irrational exuberance that you sometimes get with you know, the market at all-time highs to where everyone's just bullish, buy. I think there are a lot of people that are still, you know, there were a lot of people going into the cut yesterday that were worried about a 50 basis point cut that you know, that were saying that would signal fear that the market would, you know, sell off on that, which it kind of did, but then now is coming bouncing back right back. Does that play into, like, does the overall sentiment ever play into your feeling about the market? Like if everyone is so bullish that you're going to get a little bit more worried, or if more people are bearish, that gives you some more, you know, that you want to start buying then, or do you not really look at that?
No, I always feel sentiment. You know, you can feel sentiment even on the charts. You know, when stocks have had big run-ups into the reports, expectations are a lot higher. You know, when IWM runs straight up into a Fed event, expectations were higher. And you know what? It sold off significantly yesterday on that, probably because, you know, it's just got to catch, you know, the max amount, max pain. You know, people who are saying, yeah, here we go. The algo's it all about. I got to shake all those out. All those short-term traders that are like 50, we just got to buy stocks left and right. And then they get punished yesterday. Now they get relieved here overnight. And, you know, and obviously, you know, the path to go here is unknown by all. I mean, I'm not even going to try to predict where the S&P is going to be at the end of the day, because this could go either way. But I think sentiment is an important factor when you're a trader, getting a feel for like, what is it out there? Are we in irrational exuberance? Are we in despair? Are we in, you know, just complacency? I mean, knowing all those things helps to get a feel, because the majority of participants usually are on the wrong side of the market. The people with an opinion usually are on the wrong side of the market. When everybody is bullish something, just like Warren Buffett says, to your point, when everybody's, you know, out there and greed is apparent, that's when you should be fearful. And when everybody is fearful, that's when you should be greedy. I mean, those are great points. You can learn so much from Warren Buffett over the years, more from him than anyone. So I think sentiment's important, but it's one tool in your toolbox. I don't think you can just live on it and derive, you know, okay, well, everybody's bullish, so I'm going to be bearish. That's a contrarian strategy. And if we're not in a contrarian market, that's not going to work very well. So, you know, you've got to identify what type of market you're in. You're in a momentum market, contrarian market. I would argue we've been in a contrarian market here for quite a while. S&Ps really, we're back at the same spot we were in July. Had the huge sell-off, came back to August, came back down in September, beginning. Now we're back up here again. We've kind of just chopped around a lot. So contrarian strategies are working well. Momentum strategies not working so well, because your momentum strategies would have been buying the rip yesterday. And then boom, it gets killed. And then they're like, okay, well, I got to get out. The momentum's getting out. Now it rips again overnight. Contrarians doing well. So just more so than sentiment, probably identifying what type of market we're in. And that's, you know, I think a contrarian market here right now, where rips are getting sold and dips are getting bought. And, you know, do we eventually enter that momentum where we start going higher again? Maybe, but right now contrarians are winning.
And this is the AAII sentiment survey. So retail investors every week, and it comes out on Thursday. So this is actually today's reading over the past week. Over 50% bullish, which if you look at the 52-week bullish high, we're basically right there at 52.9%. So honestly, like, if this starts ticking higher and the market keeps going up, and then next week it says that the bullish, that 60% of traders are bullish, then you know, maybe it is getting a little crowded, and we'll continue watching that. But, you know, a lot of, you know, it's really about price that drives sentiment. When the market's going up, more people get bullish. When the market starts going down, more people get bearish. So they're looking at the
Definitely.
sentiment can sometimes be almost like a lagging indicator, but it does. I like looking at it just because it does spook me a little bit. I mean, you can just see a week over week how big of an increase this was. It was less than 40% of the respondents were bullish last week, and then now it's already up to 50%. So, you know, I'm not saying
that gets up to 70-80%. You start letting me know.
Okay. Yeah,
That's what we're selling stocks. When you see these extreme readings, you got to be very cautious. When you see extreme fear or extreme greed, that's when you really got to pay attention to sentiment. I would say this is kind of in the middle of nowhere, which is indicative of a choppy market. When you have sentiment and people are split, bulls and bears, contrarians are probably winning. So you can just go back to that chart for a second. I mean, it's pretty split. I mean, people overall usually are a little more bullish than bearish. So just because that's, you know, natural human tendency, be a little more positive. But yeah, go back to that. I want to see those numbers again there, AB, if you can.
Oh man, all right, hold on.
Oh, so making you go back.
No, you're good. I just
you X'd it out. Now you don't have it.
Our thing only
it looked like 50-50 to me, didn't it?
No, well, it's
50, 20, neutral and bearish.
Yeah, so there's only 26.4%.
Yeah, but again, most people usually are sitting here. Like, you can look at historical averages. It's a pretty good tell. 37.5, 31.5, 31. So that means when you're kind of neutral. So you're getting a little bit more to the bullish side, a little bit more extreme. That starts getting up 55 and 60, and then people are a little bit more. So you're probably never seeing an 80 on this reading here because they're including neutral. You know, you're probably never going to see it much higher. Like, it looks like 1 year bullish high 52, 1 year bearish high was 50.
Well, yeah,
so,
but
and when was the 1 year bearish high?
That was it. 1 year bearish high was in November 2023. So I guess I bet you the market.
I was just curious, where were we in November 2023?
It was probably selling off pretty good, if I had to guess, because that's when people get bearish.
Yeah, probably.
But Richard in the chat saying that I'll let you know once it gets to 70.
Let us know. When you get these
later.
extreme readings, that's when you want to pay attention to sentiment. But maybe we're a little bit more to the bullish side here than right now. But I think, you know, I don't feel like it's like that out there. I feel like it's mixed. You know, when you talk on Twitter with other traders, it feels mixed. Well, like everybody's bullish or everybody's bearish. It kind of feels mixed to me.
The perma bulls are pretty loud, so that could be part of it. That there's not that many of them, but the ones that there are, they're
the bears are loud too.
They're always
Peter Schiffs of the world.
Or that's what I meant. That's what I meant. The perma bears are
the
loud.
The
perma bears are loud. I mean, like, is there anyone more, you know, masochistic than the people that are just bearish all the time? Because how do you stay? I forget who it was, but they were saying that, like, they used to be a perma bear, and then over time they realized they were just like wrong, and then they became essentially a perma bull. And it was like, I feel like if you stay in the markets long enough, you kind of shift toward that, just because that's what the market tends to do over time. There's
analysts that have made their career just at being a perma bullish because it goes up over time. Just like, I'm bullish, just making only bullish calls. And then they look like they're geniuses because the markets go up over time. I mean, there's a career to be made there. It's a lot harder to make a bearish call than it is a bullish call, because you're fighting the trend. You're fighting everything. You're trying to call, you know, so it's a lot difficult. So you've got to respect a bear that gets it right. You have to respect them a lot more than a bull that gets it right, because it's harder to make that call.
Yeah, and my first like foray into really trading was during 2020, and I made a lot of money shorting the markets, like, into the COVID crash. And so I kind of like, that was kind of my thing for a while, was like, oh, this is so fun to buy puts and to be right about the market going down. And then I quickly learned that, you know, like, oh, this isn't going to keep working, because I kept buying puts after the market crashed and started coming back. I was like, how is this market coming back so much? No one's even working. Like, the economy is shut down. And I was buying puts in April and May, and it worked in March. And then it didn't work in April and May, and I got my face ripped off. And I was just like, all right, now I need to start adjusting my strategy. And so, you know, but that was my start, was as a bear. And then now, you know, over time I've become, I guess, more closer to the perma bull side. Just, and not to, and when I say perma bull, like, I understand the market is going to have drawdowns. It's more like when the S&P does draw down 5-10%, I'm not sitting here being like, I gotta sell everything. I'm sitting here being like, what can I buy now?
Yeah,
because I know eventually the market is going to turn around. That's what it does historically.
And I think as a long-term investor, it's important to have that mindset. It's why I never go short stocks on my long-term account. You know, the last time I took a bearish bet in my long-term account was I bought puts on the S&P, and that was pre-COVID, because you could see it coming. You could clearly see it coming in January and February, March, and we talked about that. And those puts were to protect my portfolio, not really to make money, because I thought it was going to get ugly, and it obviously did. I just think long-term, there's no place for shorting in your long-term account. If you want to short stocks, fantastic. I short stocks every day. Keep them in your trading account where you can keep it, you can keep an eye on it, because long-term shorts, it's difficult. And again, there's some great traders that trade on the short side there. They just look for, like, and this is a great point too, just talking about, mindset with trading, and people are always looking for, what's the next breakout stock? What's the next big mover? There are some really good traders out there for that. Just like, what is the biggest piece of crap company out there? And it's getting a pop here today. I'm going to short that stock. There's some really good traders that do that. And it's an underrated strategy where you find the biggest pieces of garbage, like the companies that are just struggling on every front, and you sell the rips on those companies. That's a good strategy. Companies that you think could potentially even go bankrupt. The Tupperwares, the Big Lots.
I'll throw one out there. I'll throw one out there for you, Dennis.
Sure.
How about Peloton up 6% this morning?
I mean, again, you know what I feel about Peloton. Sorry, management. It's not your fault, but it's the product. It was the COVID, darling.
It's the timing. It's the timing.
Gone.
It's the forward. It was the forward demand from COVID, and you can't live up to that. And now it's. I mean, the thing with me is why I wouldn't short this necessarily right now is because I do still think maybe there's some value there, and obviously it's been talked about as a potential takeover target for years now, and that's never happened. But I bet if I went and tried to short and also there's not that much juice to squeeze if you're buying. I mean, you can outright short a stock at $5, but that's a lot riskier than buying puts where your risk is defined. If you're buying,
and the puts are going to be expensive. I typically don't short stocks under $5.
Yeah, and that's what Robert.
Bad things happen quickly.
Yeah, I was going to say if I buy puts on this,
Robert, same thing. You took the words out of my mouth. That's exactly. I don't typically short stocks under $5. So I'm going to give you one today. And the analyst, this is going to bring us to our rating of the day. And it's 5 below. FIV. And I'm not advocating to go out here and short it. It's on a ripper right now. It's really moving here right now. But it's come up. I think this company is going to continue to struggle. I'm not a believer in the 5 below turnaround story. The $5 store, I just don't feel like it's the turnaround story. But it has ripped higher here from $64 a month and a half ago to $100 yesterday. Well, overnight, we get a rating here. I'm going to be on the same side as this analyst. I agree with that. JP Morgan downgrading 5 below to sell, underweight they call it. But Matthew Boss downgrading it to underweight, says we rate 5 underweight. In 9 of the past 10 quarters, 5's comps have declined year over year. Consumers continue to manage to a defined budget, and our waterfall initiative math points to the 5 beyond lift contribution decreasing in fiscal year 25, 26. Margins, headwinds he's citing. Lots of issues here for 5 below. This is the kind of stock that I think is a dog. This is the kind of stock that I think when we look at it a year from now, it is lower. But shorting is difficult. And if you've never shorted stocks before, it's probably not want to be on your first one, because 5 below is a little bit of a wild child. It's run up 20 points here in 7 sessions. So it's a little bit of a wild stock. But I'm saying companies like this that are struggling might be better. So I kind of am with the analyst here. He's rating it a sell. I don't give ratings. I don't give investment advice. I just give different ideas. But I think, setting up here, you get a little rally back on this stock. It's not down much today because everything is ripping, but there is an underweight here. It's the kind of stock that, I feel like, is struggling significantly. The company's struggling fairly significantly.
Well, let's stick with some individual names real quick because we've got a few minutes before. Oh, shoot. 8:30. We had jobless claims. Let's do that.
Did we?
I mean, yeah, I don't know.
We didn't even move.
Well, good thing we didn't tell you.
Oh, good thing I didn't get picked off on everything. Chat, where were you guys on that one?
Initial
Breaking
jobless
news, CNBC 10 minutes after.
Initial jobless claims 219,000 versus 230,000. So it's light. So the rate cuts worked. The labor market
It already worked.
It already worked. No, but like you said,
immediate gratification.
S&P is not really moving off of that at all, really. But just what I was going to say before that is let's stick with some individual names because we got a few minutes before our guest of the day. Tim Seymour is coming on in about 10, 15 minutes. So Darden, DRI reported this morning, which that was one of the stocks actually, Dennis, that I was shorting in the COVID markets because I was like, at the time, this is when I was working at Red Lobster, and I was like, no one was going in to eat anymore because people were getting a little spooked out, and I was getting messages on like the Facebook group saying like, hey, we have 10 servers scheduled today. We only need 3 to come in. And I was like, all right, this isn't a good sign for Red Lobster if they're saying that only 30% of the plant staff needs to come in. Regardless, Darden reported this morning, EPS missed $1.75 versus $1.83 estimate. Sales missed 2.76 billion versus 2.8 billion. So you got the double miss. Stock is up 7%. So a good day to report. The company did talk about a deal with Uber, which is probably helping the stock out a little bit. But either way, like if this company reports this report yesterday, I'd bet that it's in the red. Today it's up 7.5%.
Yeah, helps. Definitely helps. The day, we talk about this all the time, reporting on a good day is always, good news for your stock. It actually did dip a little bit initially on it. The deal with Uber probably helps. Is Darden Restaurants something that I'm looking, to put a lot of money in and invest? I mean, this is an outsized move for this stock, even not far from all-time high. So give credit where credit is due, because a lot of restaurants are struggling here, and this is one that obviously is not. I mean, Olive Garden feels like affordable fine dining to a certain extent. And people can say Olive Garden fine dining, but to a lot of people, Olive Garden's like a nice meal.
Oh, yeah. Meal. I mean, growing up, it
was great.
It was birthday. I went there with my birthday dinners at Red Lobster, and which I know Red Lobster is not a Darden stock anymore, or Darden brand anymore, but it used to be. And like a lot of those restaurants, like as I've grown up, that was one of the things that I realized. I was like, man, like I can't believe I thought this was like the nicest thing ever when we used to go there as a kid. But yeah, I mean, for a lot of people, it really is kind of like the higher end,
like a good night out with the family, affordable night meal. I think that helps to a certain extent, but they've done well. It's just not the kind of stock that I'm looking for, right now. And again, if you're coming in today and saying, what can I buy? What can I buy? What can I buy? That was yesterday, folks. That's what you should have been doing yesterday on the dip. It's not buy the rip, it's buy the dip. That's what works better. And I think when you're ripping, the rip of all rips here overnight, it's more like what kind of crap is in your portfolio that you need to clean up. I'd be looking more at what could I sell today as opposed to what can I buy. And that's not saying the market necessarily pulls back in, but there will be inevitably more dips, more opportunities to get in. So have your shopping list. If you really think that the S&Ps, are going to, continue to go up 30, 40% next year, which they might. Maybe AI drives it. Find the stocks that you like, but you buy them on dips like yesterday, looking for opportunities, yesterday on the dip, as opposed to we're up 90 handles right now, on this ripper rally that not a lot of people would have even noticed. And maybe we continue just because you've caught some shorts here overnight. But I think when you're chasing overall, it's just a bad, recipe. Like right now, if you're buying today, you're doing the opposite of that paper that we showed earlier, where you're actually buying the ripper open. Odds are maybe we're not going up 150 or 200 points today. I don't think we're giving it all back, but this takes a lot to, continue. With this much buying pressure overnight, it's going to take a lot for this market to continue to go like a lot higher here. I wouldn't be surprised if we dipped a bit, but again, I wouldn't be surprised if we held up too. I'm not trying to call and predict the market, but I'm saying better opportunities for you long-term investors. Buy on the dip, not buy on the rip.
I see a lot of people in the chat mentioning the triple or quad witch tomorrow. We will have CC Legator on from Options
awesome.
AI tomorrow to discuss that. So Even though Joel is not here, we'll have CC, and so we'll hopefully we'll be in good hands. Talking about that, we will be in good hands with that tomorrow. So sticking with some individual headlines, I'll just stay real quick on U.S. Steel, because I still feel bad about screwing Dennis up and not telling him about the CEO speaking yesterday. Up again this morning. The company put out some third quarter guidance this morning, which it was funny because the CEO, when I went and saw him speak, he's like, we're doing well without the merger, but the merger would still be better. But if we don't get the merger, we're still doing well. So he was just covering all his bases. I mean, it was a masterclass job of just sounding super bullish, which I mean is kind of his job as the CEO. But also I saw that when I walked in the office this morning, Pete Buttigieg was on CNBC talking about the deal. So the sound wasn't on. I didn't catch what he was saying. So if anyone in the chat was watching that, what Pete Buttigieg was saying about the deal, I don't even know like what he would be saying, because I think he's like the I guess steel transportation. That's probably a crossover there. But I don't know. Up again this morning. I mean, if you're just reading the tea leaves of the market, it does look more likely now that the deal is going through than it did a week ago. Because a week ago the stock was trading at $35. Now it's getting a little bit closer to where that would be if the stock does get taken out. I think it's $55 or $54 a share.
There's a chance. There's a chance here now, and that's what the risk arbs are looking at U.S. Steel is. It's a chance. I mean, the takeout price is 52. So if you really think the deal's going through, it's a screaming buy. I don't think the deal's going through. I think they kill it. So I think risk arbs is giving more of a chance.
I think I'll take the other side. I think it is going to go through.
If you think this deal is going through, you should be buying the stock.
Well, but I think it'll take a while. I think it'll be after the election now. But I mean, that's not that far. I mean, you could hold it for 2 months. I could hold it for 2 months, and if I'm wrong, I'm wrong. I don't think. I guess. Yeah. I mean, I don't know. Where'd this stock get to? Let's see.
The downside on this stock, and again, it's a moving target, but it's always a good exercise to look at where steel stocks are as well. So not just looking at where U.S. Steel was, which is November. The stock was around $35 when the takeout happened. Again, rumors started back in July, though. So we kind of were like 23, 24 when the rumors started. So if you look at where steel is from then, July, Nucor, we're kind of right back to where we were. Steel Dynamics would come down, but we're not quite back to where we were. Arcoa is up a little bit. So you're probably up a little bit. So if they kill the deal, it's probably $30. But remember, you have the Cleveland Cliffs. You have the wild card. That Cleveland Cliffs said they're interested in the 30s too. So you do have underneath demand with a potential buyer at $30, 32, maybe 34. So it's not a crazy buy at 37 because I think your downside 7. I think you have 14 up and 7 down. So I think risk arbs are probably pricing in a 33% chance this goes, 66% chance it doesn't with a $37 price. That's my quick risk arb, and say risk arb. I trade risk arb for years. That's how I would price it out. So I think that's $30 on the downside, 54 on the upside, or 52, whatever it is. So I think it's like 14, 15 up, 6, 7 down, 2-to-1 risk reward ratio on that. But I think the odds are it doesn't go through. So that's why I'm not long.
There you go. Someone in the chat, that's what we were talking about yesterday. Rename it, then you sell it easily. That's why I think the deal is going to go through, is because if the company had a different name, no one would care. This deal would go through easily. And
but it doesn't have a different name.
I know, but
that's the issue.
But I hope at least that the people in the antitrust department
they don't
look at
they look at the name and it's political.
I know, but
they're not that like, well, if it had a different name. Well, it doesn't have a different name.
I know, but I don't know. I just would hope that some people have like the logic to look beyond just the name, but maybe not. Maybe that's thinking too much of people. But all right, let's stick to some. Let's stick to some individual
logic. What the hell is that in Congress? Is there logic?
I know, not a lot.
No, there's none.
Because probably I don't know. There's a lot of people in Congress that their brains probably stopped working that well 20 years ago, and they're still in there. But all right, let's go to DJT real quick, because just sticking with some individual headlines. Wow, is this right? I mean, we're not. Hold on. Let's go to.
It's correct. DJT is one of the only stocks that you're going to find down today. So
I know, but this happened in the last 10 minutes.
Consumer staples are rolling over. Procter & Gamble, Coke, both red now. Utilities, Dominion, these are not the stocks you're looking for on a day that you're up 8. Don't be buying utilities on a day like up 8. At least I would not be.
Yeah, well, DJT, was slightly in the red when we started the show. Now in the last 10 minutes, I'm looking at we're looking at 5-minute candles here. In the last 10 minutes has taken another leg down. The news here is that today is the day that the lockup period ends, to where insiders are the first day insiders are able to sell shares. Now, Trump himself has come out and said he's not selling, and he's if not a majority stakeholder, holds like 50% of the shares. So that's significant if he doesn't sell shares, but there are a lot of other insiders that could sell today. And I mean, if I were an insider and holding shares, and I've been seeing, my money going down, down, down over the last few weeks, I'd be considering selling some of those shares today. And now you're looking at it trading at its lowest point since going public. So could be just something to watch today. Again, I don't know. Go ahead.
No, I was going to say, so this is the last day of the lockup, so I believe they can
sell
so
tomorrow.
I think so. Again, I don't follow story. Chat, correct me on that, but I believe they can start selling tomorrow. So there's fear of selling ahead of this, and this is like an event as well. So knowing these events, this is like a bearish event for the stock. And it's not surprising the weakness that we're seeing ahead of it, where people are like, oh crap, lockup's coming, I better get the hell out. Sometimes what you see is actually the low happen on a day like this ahead of it, and then nothing burger happens on the actual lockup. Sometimes it gaps down, but then it actually has a relief rally sometimes. So sometimes it's like an event where everybody's anticipating the worst, and then Trump doesn't sell on day one. They're like, oh, he's not selling, and we go out back, or he says he's already said he's not selling, but we'll see. He's allowed to sell obviously after tomorrow.
Yeah, and I don't hold this stock or anything, so I'm not trading. I was just saying, if I were an insider and a few months ago the stock was at $30, and you look at your position and you're like, oh wow, I have all this money in DJT. Then you look today and it's cut in half, and you're like, man, I don't want to keep bleeding. It would be, I think maybe there probably will be at least some insiders. So how does it work though with the filings, Dennis? Will we know, I guess if someone's over 10%, we would know like the day of or the next day if they sell, but if they're less than 10%, then they wouldn't have to file for a while. Is that how it works?
Yeah. So actually, if you're looking, and again, the Brentster was always great on this, so I could clarify with him too. I think you got to file within 3 days. I might be wrong with that, Chad, if you want to correct me on it. If you're over 10%, and if you're under 10%, you don't have to do until the 13F day, which is 45 days out. So I mean, completely different. So that's why sometimes we see Warren selling. All of a sudden, you don't see any sells anymore. Well, he may have went under 10% in the stock, and now he doesn't have to report until afterwards. Like Apple, we don't see the regular sells in Apple because he's under 10%. But on Oxy, we've seen every single buy because he was over 10%. So those are the considerations.
All right, sticking with some individual.
Richard saying it's within 24 hours. Ben saying 3 days. I know it's 3 days or less. I'm not sure what the actual rule. I should go look that up actually, but just be aware of that.
All right, someone wanted to talk some Apple. I don't know if Apple had specific news or if it's just up $4 on the with the overall rally. I think that's what it is. I think Apple's just ripping higher on the rally. But this was one that it dipped the other day on the weaker than expected iPhone demand. Pretty much filling that gap back up to the upside. You can see here that day that the market, or that Apple went lower on that news about the iPhone demand. I mean, Apple is now back above 225. I think back again, has reclaimed its title as the largest company by market cap, $3.35 trillion.
It passed Microsoft?
Yeah.
Oh, wow. I did not know
Unless
that.
Microsoft caught back up. Let's check. Yeah. Apple currently has a larger market cap than Microsoft. Wow. Morgan Stanley came out and said, or T-Mobile CEO commentary on iPhone 16 demand is positive. So you're kind of getting some now mixed signals here on the iPhone 16 demand. And I threw it out there at the day. I was like, getting this, if the iPhone 16 demand is a little bit weaker than expected, like obviously it's not good news for Apple, but I don't think it's like the worst thing in the world, because eventually Apple just seems to always find a way to come back. You know what? No matter the bear.
Sure.
Okay. The Vision Pro was a flop. It was a bust. It was a nothing burger. What happens? Apple stock keeps going higher. It seems like no matter what happens, even bearish headlines ultimately leads to Apple stock going higher. Will that trend eventually stop? Sure. I mean, Apple can't just keep growing at the rate that it's grown at over the past 10, 15 years forever. But as it is now, every single dip on Apple, in the last 20 years has been a buying opportunity. And it's one of my biggest holdings. I never got scared enough to say, oh, I want to sell some of my Apple shares just because iPhone 16 demand might not be as strong as it was expected to be.
Yeah, I mean, buy good companies at reasonable valuations. Apple is the best company.
But it might not be a reasonable
Valuation, I
valuation.
say, is not reasonable now. That's my argument, but maybe it grows into that. Maybe it does become this AI powerhouse, and you look at this and say, well, those earnings were going to start to grow, and that revenue was going to grow. That's the bull case scenario, that they actually start growing revenue, because they haven't been growing revenue in years. So maybe, they're going to have something that's going to move the needle, and they're actually going to start growing revenue. I am going to wait for that product, though. Show me the money, I'm going to say, with Apple, instead of show me the buybacks.
Sound like a Missourian.
Is that how Missourians sound?
Well, it's the show me state, but it's okay.
I'll
give you a pass on that because you're,
Canadian, and I don't know.
Canadian.
I knew it's the show me state.
Do Canadian provinces have their own sayings like that?
I don't even know. Okay, I know Ontario is yours to discover. It used to be, but I think they might have changed that, actually.
That's a good one. Yours to discover, because there's a lot of nature and stuff up there.
Yeah. I mean, I look outside and it's a lot of nature out there. I fight these Canada geese every day, and all this nature that's out here, it poops on my lawn.
I don't know. This is random, but it just reminded me. Speaking of yesterday, I had a first ever on the golf course, Dennis. I hit a deer with my golf ball.
What?
Yeah, there was deer running in the fairway, up in front of me, and I was like, whatever.
Was it okay?
Yeah. Oh, my ball bounced, and then the deer hit one of the deer in the leg, and then the deer just ran away. I was like, well, if some people shoot the deers, I just hit one in the leg with a golf ball. So
that's a good shot, though.
There's
a lot of deer out there when you're actually hitting them with your golf balls. I've never done that either. I've seen deer on the course. I've never actually smoked one with a golf ball.
I literally was it was my aiming point. I was like, oh, it's right on the left side of the fairway. I'll aim at the deer. If my ball cuts back a little bit, it'll
and
be
you
right
hit it direct.
And I hit it.
Well, aims at the deer and hits the deer. That's a good golfer.
I didn't hit it on the if I hit it on the fly, if I just smacked it on the fly, I would have felt bad. Oh, yeah, and actually my buddy that I was playing with yelled 4 at the deer. I was like, I don't think the deer's gonna
deer move 4.
I don't think the deer's gonna understand 4, but yeah, that was funny. It was the first time. And then later in the round, my buddy hit a squirrel, so we hit 2 different animals on the golf course.
Squirrel probably didn't fare so well.
No, well, it was still fine. It wasn't. All right, let's. I see Tim Seymour just hopped in the stream, so let's go ahead and give Tim our special pre-market prep welcome and see what he's thinking about the market. All right, Tim Seymour, welcome back to Benzinga's pre-market prep. How are you doing this morning?
I'm doing great. That is a badass intro sound, and I mean it's rocking.
It gets you
pumped
up.
That, Aaron? Are you playing the axe on that? What's going on?
I cannot take credit for any of the videos or bumpers that we play. We have a great editing team. I don't know if Tiny Pie is in the chat, but he can take credit for that. Yeah, I mean it gets me pumped up every time we hear it. It gets the guests pumped up, especially early in the morning. Early in the morning, if the coffee's not working, that will work.
Yeah, I get it. Not surprised. Benzinga has some groovy tunes here. Good morning, guys. And look, I'm not going to call animal services on you, but I mean, everything I've heard, I'm horrified. I mean, what can I say? I will say that last weekend I was trying to take out bunnies in my yard. They've absolutely just changed. They've literally changed the landscape. But that's probably for another show.
They like eating the plants.
Well, Tim, let's bring it to the markets real quick, so we can talk about our animal stories forever. But yesterday, of course, we got the Fed decision. It was 50 basis points, which a lot of people were predicting. The reaction was a little bit, roller coaster up and down, and then today it's just straight up. What do you make of this move? Why do you think there was this kind of delayed reaction overnight?
I think every word is parsed through on a Fed statement, and I always used to refer to this as like the cha-cha-cha, and I think there's an extra cha this morning because it definitely, to me, they were clear, and the more important thing that they were clear on, the two things that were to me the most bullish were when I hear 2% GDP growth, and I realize the Fed isn't necessarily right all the time in terms of their economic prognostications, but 2% into 27. With a backdrop where they're there to support labor and ultimately, again, their mandate is, if anything, totally balanced at this point. That's providing both kind of the macro and also the policy response. in a world where we've never seen earnings growth going into rate cuts like this. In other words, this is an unorthodox rate cut on some level, even though we all know that seemingly we were very restrictive on policy. Markets' reactions to these types of things, again, I don't know. I mean, look, we came into the announcement at all-time highs. Why wouldn't we take a breath and digest it? But the things that are going to be, I think, also major determinants of at least medium term, the short term, we can all try to handicap here, but I think is what's going on with the currencies and where we are really on the yield curve. I still think that rates have come in too low, even on the long end. I think that bonds in terms of rates were indicating recession, commodities have indicated recession, equities and credit have said game on. And something needs to give. So I do think you need to watch those dynamics. But it was a day when, again, so much had been built into this day. 25 or 50 really didn't matter. In other words, if they had said 25, would we have had a better outcome yesterday? I don't think so.
I think, Tim, looking at the action from yesterday and the sell-off, I think kind of the overseas markets saved us to a certain extent here. And, obviously you're an expert on looking over there. I mean, looking at Japan had a huge night, up 2.4%. European markets did very well. And then look at China. I mean, China had a great night last night. FXI is up 3% here this morning. I think this was a big story and why the U.S. markets, maybe they were going to bounce regardless, but, with the significant bounce we've had, I think we can really thank the overseas markets for that. Give us your thoughts on China, because this has obviously been, a huge laggard trade. Stocks like Alibaba have been huge laggards. Is there the potential here that this turnaround could actually be real?
Well, I'm not sure, because I think China's economic dynamics are ones that are structural and not easily solved by policy, but policy hasn't really done enough. I think when I look at Alibaba and Tencent, I think I see two of the world's most valuable tech companies, incubators, et cetera, et cetera. The story there has not really been about the Chinese economy. It's been about the Chinese government and how they, at least at different times, have really put the boot to the neck. And I think we've had a lot of signs and a lot of détentes over the last 6 months that have indicated that period is over. So the international growth at Baba is well over 40%. The balance sheet is still 40% in cash. The growth here is fine. I like Alibaba. I've liked Alibaba for a long time. I've traded it, but I haven't traded it as much as one should have traded it, because this is a stock that's had these 30 to 40% trading ranges. I do think, as it relates to international, what I've always understood as someone that's been, especially from my emerging market days, is that if the Fed is at least in a easing mode, or we don't have a hawkish Fed, it provides a backdrop for international markets to outperform. So we've seen the dollar give back 5.5%. We know also what a weaker dollar does to commodity prices, but also the commodity producers tend to rally in that type of environment. You think about where a lot of the global market cap is, especially in EM. If you look at, say, the EEM and try to, make at least some guesses on where we've gone over the last 2 years, you can make an argument that once the Fed really began to peak, in terms of, at least we were at peak rates, you started to see EM slowly grind higher. You can't oversimplify places like Mexico and Brazil, where you've had in each place in the last 2 to 3 months some real concerns about what's going on in terms of both the politics and the posture of the government, et cetera, and also what's going on with policy. But if you want to oversimplify, I think this is a great environment for global. I'll get a small advertisement in. I'm a PM for an international ETF, ticker IDVO. IDVO is basically a international blue chip, at least best of breed balance sheets of companies, also where they're growing their payout levels, and where we write covered calls against, again, a portfolio we think of both mostly DM but some EM stocks. I mean, this is a great time to be investing in that kind of stuff. What we've seen in across the U.S. market, what everyone's pretty aware of, is the outperformance of the equal weighted, the SPYV, and even where Clearly, this lit a fire under small caps. Some of those dynamics
Uh-oh.
I think similar to in other words, what are drivers for some of these companies? It's certainly been a period of 3 months where that's been a sideways to down trade in terms of the relative performance. So if we remain in this mode, and again, I would say commodities behaved over the last 6 months like we have a recession. If the Fed's right on a 2% economy for the next 2 years, and they're there to facilitate labor growth, and by the way, no one needs to necessarily rule out a rate hike over the next year and a half, too. In other words, if you got that, that's maybe a sign of inflation, but a sign that also the Fed doesn't need to be that accommodative because the world's not coming to an end. So my final thing on all this is, if we don't have a growth scare, we have a market that doesn't have the day we had on August 2nd and August 5th. And those are the two big drawdown days that had everybody thought we were going into the worst month of the year with a chance to break some records.
Well, Tim, what about, I mean, we mentioned the political climate of China here in the U.S. We don't like to talk politics a lot on this show, but of course, with the upcoming U.S. election, does your strategy or perspective of the market change at all based on who wins the election? Do you think, there are any specific sectors or stocks we should be watching into November?
I love how we all who find ourselves in financial media love to disavow any political association or any political conversation. It's true, though. I mean, no one cares about our politics. So there's nothing worse than hearing someone who's got a platform on something completely different. And it happens when you go to concerts. You hear lead singers doing this. You hear this goes on everywhere. So it's not going to go on here. But you're asking me a specific question about based upon policies or something I like. I mean, what we can say from both administrations is they're going to be terribly budget unfriendly. Everything I've heard is that this is going to be an environment where I want to own gold. It's an environment where I want to own some hard assets. I continue to think, gold is the best 20-year chart out there. It's also one of the best 2-year charts out there. It's outperformed the S&P from that CPI low in October of 22. That intraday low to today, gold has outperformed the S&P. And remember, the S&P had an intraday low as well. So I love gold here. I continue to think that some of the plays around uranium and copper and some of the dynamics that I think have been driving those markets that are a little bit more industry specific. I still think that we do have supply dynamics in the copper markets that will support that. So you don't buy commodities when they're cheap. You buy them when they're running and when they're expensive. So I mean, these are trades to watch because a lot of these things are kind of beaten up. But I like that. I also think energy. What I've noticed in the energy space is that appropriately analysts have come around and they've downgraded their price on 24 and 25. It's kind of a structural thing. You do it 3 quarters through the year, you're not going to hit your 75 a barrel. So you go down to 71 and you adjust your models. I mean, a lot of these integrated oil companies look fantastic to me. And Chevron, I would put at the top, but Exxon looks great. In IDEVO, we own Total, we own Royal Dutch. I think this is a trade that hasn't performed of late, and I think these are places where, and I see you've got the chart up there. I mean, there's decent support, 5% under this, and there you have to really watch out. But I mean, I think either way, I think these are companies that it's not because the valuation is that compelling, but their relative valuation to the S&P is something, to the market overall is something that you kind of need to pay attention to, and I think that's pretty extraordinary. So I think those are places in either environment where I continue to think we've got progress. Some of the secular trades around, I still think that software security and some of these elements that have defined both the world we live in and defined kind of investing also in high growth companies will continue to work. I think you're buying weakness. I think some of the moves in names like Oracle and some of the names that really have had outsized moves are a little puzzling, but again, you're getting the sense that some of these companies are competing now in a way where you've got a material change in the revenue outlook. I mean, that's been the story in Oracle over the last couple of days. So, and I think that I wouldn't be getting too far away from some of the mega cap tech trades. I kind of like, I like Apple here. We had a segment last night on the show where we featured an analyst at Morgan Stanley who put a buy on Apple and said, hey, if it gets to 200, I'm a buyer. And I the analyst is very good at what he does, and it's a good call. But, why wait to 200 on Apple if you want to own Apple on a refresh cycle? Apple's not going to be cheap at 200. It's not overly expensive at 220 if you believe that it's a world we live in where not only the refresh, but the software revenue, the balance sheet flexibility, the share buybacks, AI is going to be served up through people's phones. Come on. I mean, it's what we've seen in everything. And I still believe, as we've seen with ChatGPT and even Microsoft and Google, they're all falling all over Apple to get that distribution into that installed base.
Well, there you have it. We're running up on time here, 9 a.m. But Tim Seymour, always a pleasure to have you on Pre-Market Prep. When are you going to be live? Where can people catch you next?
Well, again, Fast Money tonight. I'll be there. We're there every night at 5 o'clock. Tune in and please keep us up to date on what you're thinking about what we're doing on Twitter. I'm going to be in Chicago in about 2.5 weeks, 3 weeks for a Benzinga cannabis event. So nice. I'm on a few panels. I'm moderating. It's always kind of the place to be for cannabis. This isn't a paid advertisement, by the way. I enjoy being there because I think there are truly both investors there and there are market players, and it's always a forum that I think is done in a creative way. So people should check that out. Cannabis is also a trade that I think either administration has kind of showed that they're ready to roll on significant things. Don't hold your breath on cannabis in terms of a headline that you want tomorrow. Be investing along with the fundamentals and the view that this is still not institutionally held at all. And that this is an industry that, depending on how you're measuring it, I can make an argument it's a $100 billion global industry right now. But
there you have it.
I'll be in Chicago. It'd be great to be there. It's great to be here with you guys. And obviously, Dennis, at some point we've got to do a hockey preview. So let's get going. We do.
Let's make that happen. We'll make it right happen. The hockey preview show here on Benzinga. We'll get Tim over here.
Training camp. I think that
could be the Rangers' year. The Oilers got close. They were so close. It was so disappointing. It took me a long time. I'm still not over it.
All right. Well, thank you.
Yeah, I'll shut up on hockey.
Go ahead. Go ahead. Go ahead.
I was just going to say the big philosophical question at the end of a very, very successful year by any standard, but not winning the cup is you're not happy then. But you can now look back on that year and say it was a good year, and we've got a lot to build on. So that's my philosophy of the day, guys. I don't know what it means, but put it to work.
There you go.
Thanks,
all right,
Tim.
Well, we'll see you in a couple weeks in Chicago. Thanks again for hopping on Benzinga's Pre-Market Prep. We'll see you soon.
See you later. Thanks.
All right, guys, that was Tim Seymour, of course, from CNBC's Fast Money. Like he said, he's going to be at Benzinga's Cannabis Conference. I'm throwing that link in the chat if you want to check out more of that. We'll be in Chicago here in a couple weeks. Excited about that. Dennis, any final words about the market as we head into the open today?
We're leaking a little bit here. I think it's going to be a choppy day. I don't think we're going to be at 570 on the SPY when this day closes. I think you're going to have some reps. You're going to have some dips. I do think we caught some traders overnight, so I'm not looking for this rally to fade and give it all back. I'm not coming in with that trade here today. I'd actually be looking for dips to buy. If you get some pullbacks here on some good companies that you have on your shopping list, like let's just say we pull back, there's going to be some opportunities here. We can see clear separation happening now. They are indeed selling the consumer staples. They are indeed selling the utility stocks. When we first started the show an hour ago, you had a lot of consumer staples that were trading the green. That has not happened. Procter & Gamble's now down. Coke's now down. Pepsi's now down. Walmart has turned red. We have utility stocks like Southern, Duke, XLU itself has turned red. So you can clearly see risk on tape means risk off for those stocks.
Well, there you have it. Fun show today. We discussed a lot, had a lot to digest with the Fed decision, the reaction, the delayed reaction, what's been going on this morning. So, guys, prepare for, I guess, what could be kind of a up and down choppy day. We'll be back tomorrow, of course, 8 a.m. It is a triple witch or quad witch, one of the two. Either way, we'll have CC Legator on from Options AI tomorrow morning, 8:30. So make sure to come back for that. We will have live trading starting up after this. So stay tuned for Ryan Faluna and crew. With that, guys, stay green and we'll see y'all tomorrow.